asset this morning is palladium. Yeah. PALL. Told you. We're still long. We're still rolling with this. And it's all because of this chart. Long term, strong momentum. Stop back at 99. PALL has been one of our favorite positions as we deal with the never ending turmoil that is U.S. trade. All right. July 28th. We'll do our morning checklist. We'll talk about this busy week. We'll discuss the pre FOMC and then obviously how to trade the Fed, which I will be doing on Wednesday as well. But as you know, we are joining us this morning because at 9:30 every day, the market opens and you are the exit liquidity. You need to be aware of what is happening ahead of time. So we're going to talk about whether or not this market is safe. We're going to talk about momentum, the stocks that are breaking out, breaking down. We're going to go through all of our watch lists ahead of this week. But let's dive into the macro side of this. The EU and the United States deal looks imminent, and that is going to help ease some risk sentiment. The tariff framework would stabilize markets. The EU to invest $600 billion and buy $750 billion in U.S. energy. And that is why we have this nice little move today on WTI and crude as well. No real shocker here because as I noted last week, I was looking at the energy markets and it was starting to sell off. We always pay attention to the OIOU, which is a leveraged ETN in the energy upstream oil and gas side. And this started moving higher. I do not believe in coincidences. So I fully anticipate that there was market knowledge of a trade deal imminent and the impact on the energy side of this. In addition to this, pay very close attention to the UNG today. That is the U.S. Natural Gas Fund. We're looking for this to rebound, to get a little bit of momentum back. We haven't seen it in a couple of days, but if you get back above that 20-day EMA, UNG and virtually everything that is linked to it will be a positive upside trade. We will talk about that more this week. The Federal Reserve. I think you've heard of it. Has anybody heard of the Fed? Do you know what it is? You know what they do? I don't even remember anymore. The Fed has a mandate to stabilize prices and to help implement full employment in the U.S. economy. That is known as its dual mandate. But nobody seems to care about that because at the end of the day, what everybody wants to know is who's going to replace Jerome Powell. And Jerome Powell, the Federal Reserve Chairman, who has been underseeing this, whatever you want to call it, recovery, he is under direct political pressure. So tomorrow, on Wednesday, 2:30, Jerome Powell will speak after the Fed unlikely cuts rates, not likely to cut rates. We pay very close attention to what is called the CME Fed Watch, which is available and free, and it tells you what the probability is, according to the markets, according to the futures pricing, of a rate cut on Wednesday. Markets are pricing in a 97% chance that we are not going to see a cut, but it is the September meeting that everyone is all excited about. Are they finally going to cut rates? Once again, 61.8% chance of a 25 basis point cut, 2% of a 50 basis point cut. But at the end of the day, what I pay attention to is where is this going to be on election day next year? And the markets are pricing in a pretty sizable level of cuts into next year. Now, I will remind you that even though the markets have priced this in, they did that previously. Back in 2022, Jerome Powell actually very quietly said that the Fed would not actually achieve its inflation target until 2025. Well, here we are, and we're still waiting. So the expectation is 2026, 2027. But overall, look at these numbers, 3.25 to 3.5, 27% chance, according to the futures market, 3 to 3.325 basis points, 23%. There are some people making some bets that we're going to be at 2% next year. That's wild. I'm just going to tell you this right now, probably not going to happen. But pay very close attention to this, because even in the face of higher interest rates, the markets have continued to move to all-time highs. That matters. Why? Because it's not about policy, really, at the end of the day. It's about the sheer amount of money that they keep pumping into the system, the fact that we continue to move to short duration T-bills, which adds juice to the markets. If you are concerned about the markets, if you are waiting for this market to crash, if you are reading newsletters where someone is saying that the end is near, I will remind you, I have a very little simple tool that you can look at every single day, and that is our momentum gauge. It is currently positive, and then we bounce that against the FNGD. If the FNGD breaks its 20 and its 50-day moving average, that's where we start to get worried. For right now, we are green, as we will break down in a moment. And of course, as you know, Microsoft, Apple, Amazon, Meta, all the big names reporting this week. 150 companies in the S&P 500 will be reporting earnings this week. So expect some fireworks and expect a lot of drama, especially with Apple reporting at the exact same time that the U.S. Federal Reserve will be making its statement. Every day, I give you this beautiful chart that was made in Excel. Look at that. Look at that rainbow spectrum. That is some 1999 Microsoft Paint level stuff right there, everybody. But I don't know how things work. I don't really understand. I understand math. I don't know how to make things even flashier. So what you're looking at right now on that gauge is our momentum strength. Now, you might have seen this something similar in the past. What you have seen before is, that extreme breakout, the extreme greed and fear index that happens in the market. It operates a little similarly, but we have a little bit of a mathematical formula that we utilize to help us identify in the event of crisis in this market. We're measuring the number of stocks on a bell curve that are in breakout territory versus the number of stocks that are in breakdown territory on the S&P 500. Right now, there are 14 more stocks on that breakout pattern than there are in the breakdown, and that number tends to change, obviously, when the market opens and there is a lot more volume in the market. But as we said, when this number goes negative, we bounce this against the FNGD. We look at the Mag 7, we look at the S&P 500, and if that figure is negative and we start breaking the FNGD 20-day moving average, that's where we start to move to cash. That's where we start to hedge positions. That's where we start to play defense. For right now, things are still very smooth. There's a lot of capital flowing into the system. There's a lot of money moving into stocks. And as I noted over the weekend, a lot of foreign capital continuing to pour here into the United States. Very bullish for stocks, very bullish for the markets. But as we have seen in the past, things can change on a dime. So I continue to just say, listen, get up in the morning with us. Hang out with us in the morning. I will let you know if something is wrong, because we have not missed a financial crisis going back to 2020. February 2021 was the very first time that our figure went negative, and then we had the COVID crash 3 weeks later. We went negative on August 1st last year. Well, there's the Nikkei crash, and we went negative on February 21st of this year. And here's what happened in April. So once again, smooth skies right now. Earnings have been very strong for the S&P 500 top stocks, but now we start to pay attention to what is breaking down and what is breaking out. As I've noted, we are paying very close attention right now, regardless of market conditions, to companies that are very strong in terms of their capital efficiency, companies that are very good at turning $1 into many dollars. And this is a Warren Buffett special. That is Pool Corporation. Stock had been breaking out. Right now, trading at 325, pushing above that 200-day moving average. It is still one of the better and more interesting companies. But as I've noted, if you're looking for stocks that are breaking out, don't wait until they absolutely soar. We want to obviously focus again on utilizing momentum indicators that help us identify breakout stocks. And we go back to the same indicators over and over and over again. This starts with Grant Henning's book. What is that called? The Value and Momentum Investor, and then breakout stocks. I forget that. I'm blanking on the name of it. Oh well, just look his name up. Go onto Google. You'll figure it out. RSI over 50, MFI over 50, MACD positive direction, ADX turning positive. Well, obviously, that all really heavily aligned with the 20-day and the 50-day moving average for this stock. Very strong capital efficient company. Stock pops from 300 up to 325 in about a week. And there are lots and lots and lots of these names. I will be focusing on this today at 1:15 when I am in the member room. We're going to go through a number of these different types of companies, and we will be reevaluating all of these core indicators moving forward. All right. On top of that, we are seeing strength in the housing sector. And this has been one of those things that a lot of people do not want to touch because of the macroeconomic sentiment. People are concerned about interest rates. People are concerned about overall expectations in the housing market. Are 30-year rates going to come down? Well, at the end of the day, that's all window dressing. That's all narrative. If you recall, I did a full week where we broke down insider buying activity, 13Ds, which are effectively the filing reports of hedge funds. We analyzed 13Fs and we analyzed 13Gs. What I was explaining at the time was that in addition to companies like CoreWeave, which are those big AI, companies of the future around electricity, I said there is a lot of money flowing into housing stocks. And the reason for that is pretty simple. They're cheap. They're still very, very cheap. You have a number of these companies that had very, very strong Piotrowski scores, low price to gram numbers, and they were starting to break above their 20 and their 50-day moving averages. Now BLDR has found support at its 200-day moving average at 136. So if you are the type of person looking for opportunity, this would be a place to simply bake in a stop. We saw this test here. It created resistance on the 200. It fell back to its 20 and its 50, and now it is pushed back above its 200-day moving average. And as I've said multiple times, housing stocks still are cheap. It's just a question of whether or not you're willing to trade them and simply have very tight stops around those names. Here is a Brandon Chapman special, Kohl's. And Kohl's continuing to hold above that 200-day moving average. This was a short squeeze that transpired last week, a monstrous move and a reminder of why you need to be paying attention to ghost prints. If you look at what is happening here, right, you look at how this stock moved above its 20. There was no fair warning that this was going to transpire. But it is a constant reminder that when we are looking for stocks that could potentially break out, high short interest, movement above their 20 and their 50-day moving averages, and very tight stops. He had a 350% return on that trade, and it's a reminder of why you need to be paying attention to everything that Brandon and the rest of our team are talking about every single day in our member room. This is a phenomenal move, and once again, anyone who's trying to trade it, it might be too late. You need to move on to the next list. On the weak side, Adobe. Adobe remains under a lot of pressure right now. And I don't know what the full narrative is. It has just simply continued to struggle to break back above its 20-day moving average. And it is obviously negative on all of these core RSI and MFI numbers, weak on the ADX. A little bit of strength has returned on the MACD. If you were going to try to find upside on this stock, I would not be touching it unless it can get back above its 50-day moving average. Monday's watch list, RNGR, WB, JD, PLAB, and CRC. A lot of focus will be in the energy sector today. There has been a lot of short covering that has already started. Ranger pushing above the 20 and the 50-day moving average. I like this as a trade where you buy a call at the $12 level if there's availability, and you sell a call up at 13, just simply trying to take advantage of what the market is giving you. Senor Roberto, thank you. Trading Stocks by the Numbers. Grant Henning. Great book. Must read. 5 stars. 9 o'clock in the morning. We've got 20 minutes, and we have to dive into the stocks that are breaking out and breaking down. So, as I said, one thing that we're focusing on are these core indicators. Relative Strength Index, which is a price momentum oscillator. the money flow index, which is the volume and price. EMA is a support line, and MACD, which is a short-term trend oscillator. And we want to look for stocks that are over $100 million. This is our screen of stocks that are just pushing above that RSI or an MFI and have just pushed above their EMA 0 to 5%. Now, some people have asked me because they've run this screener themselves and they've said, hey, Garrett, this doesn't do anything. This EMA, I add this at the last second and it basically just takes us from 27 stocks to 27 stocks. Well, yeah, that's okay. Because as you're going to find out, when you have these very specific conditions lined up, more likely than not, I would say probably 95 to 99% of the time, those stocks are already pushing above their EMA, of their 20-day EMA, if they are in these conditions. DR Horton, DRH, right, is now sitting at the top of this list. And why does that matter? Well, as I noted, or forgive me, Donimer, Diagnostic Health. I want to go back to DR Horton in a second. Push above that 20-day moving average. I'm looking for this to push back to its 200-day moving average. Healthcare has seen a little bit of strength, and I continue to remind you that if you are looking in the healthcare sector, always trade biotech if this is a very important condition, the LABU, which is the leveraged ETF around biotech, has to be above its 20 and its 50-day moving average. The reason is broader market, broader sector is seeing strength and momentum. If you're trying to go long biotech for whatever particular reason, pay attention to the broader index itself and ensure that capital is flowing back into that sector. You can also just pay very close attention to what's going on in the healthcare space. And as you can note, last week, very strong momentum. This was actually the top performing sector in the S&P 500 last week. It is evidenced by moves on the LABU. I did a whole big focus last week on the healthcare stocks as well. I am not trading any of these health insurance names unless they can break above these key moving averages. And for right now, very ugly. If you want to separate the healthcare stocks out, the healthcare plan stocks out, bring it down to the LABU, which is the biotech leveraged ETF, and you can be long biotech in that environment. So once again, DHR is moving higher today. Nice little stop back here at 200 if you are actively trying to trade that name. In addition to this, looking at the other names on here, we have Aon, Autodesk, LH, name that has popped up a couple of times in the last couple of weeks, LabCorp Holdings. Again, strength on the momentum side. I continue to just remind you, when you see these moves all happening at the same time and a move above the 20-day moving average, that becomes your opportunity to strike. Just keep a very tight stop and look for upside opportunity. In addition to that, we're paying very close attention to some other names that have popped up on this list. RCell, Fuel Cell, I've talked about quite a bit. FCEL. Tried to make a trade on this on Thursday. It just did not find momentum. But as I have noted, once we're back here at that 200-day or 20 and 50-day moving averages, that is kind of where I like to try to take a shot at this to the upside. This is one of those sympathy trades that we have discussed that is aligned with Tesla. All right. On the other side, what's breaking down? Well, we do the exact same thing, right? All we're doing this time is we're taking the RSI, the MFI, the MACD, and the DMI, and we're going in the opposite direction. We're looking for stocks that are moving down, and it is just the exact same thing. You're looking at the 20 and the 50. Now in this environment, I'm just going to point this out. Yes, there is weakness here, but I want to point something out that's very important. In this environment, in a broader macro momentum environment where there still is a lot of capital flowing in, there's still a lot of strength, and every single sector has positive momentum right now. All 11 sectors are still positive. When these names start to break down, I don't like to try to short them. I only like to try to short these stocks if the sector has gone negative or the broader momentum in the markets has gone negative. And there's a reason for that, because at the end of the day, I'm not trying to basically fight the market. I'm not willing to go against the market unless there is something significant happening, because those big negative momentum events that have been happening once a year, sometimes twice a year, I don't need to try to short something unless it is extraordinarily stretched. And I mean the RSI and the MFI are both overbought. When we get into these levels of these breakdown momentum stocks, what I like to screen this for is just in case I own this stock. If I own a company like Greenbrier, or I own a company like Comcast or Texas Instruments, if it is breaking down the way it is and I own the stock, well, what I'm going to do in this environment is probably either sell calls on my existing position, or I'm going to hedge to the downside. I'm going to look out and maybe buy puts in case I'm concerned about something significant happening in the next couple of days or weeks. Because again, these stocks break down, and the question is, how much exposure do I have as an investor? So when I look at the screener, I have to focus on the broader momentum in the market or the broader momentum in the individual sector. Texas Instrument having a bad time, right, moving into oversold territory. But as you can see, there is still strength in the semiconductor sector. The SOXL has been really, at the end of the day, one of the most important signals for broad market momentum going back at least 2 years because of the focus on NVIDIA and companies like Micron and companies like AMD. As you will see, nothing great happens in the broader market when this really starts to break down. This is the start of the negative momentum event that happened back in February. This obviously sold off very, very strong. When we got our return to momentum, we turned positive on around April 23rd. The SOXL turned positive on April 25th. $12.18 to $28 this went to. That was how powerful the momentum move was for the broader market starting at that time. So once again, I am not going to try to short a company like Texas Instruments or Intel or anything else so long as there is this broader support and broader momentum in the semiconductor space. If the SOXL starts to break under its 20, starts to break under its 200, starts to break under its 50, that's where I'm taking my shot. That's where there's opportunity to really hit these names that have a lot of leverage. It takes a lot of time. It takes a lot of patience, but I promise you, it's going to come. And to give you a little bit of an understanding of this, just look at what has transpired with the SOXL during significant periods of volatility in the broader market. You already know what happened back in February. You know what happened in March when we had that short squeeze. If you go back to August, this sell-off that transpired, that started in mid-July in the semiconductor space, was a precursor for the Nikkei crash. The SOXL went from 70 to 23, right? Shaving a ton of value off of this individual ETF. The reality is when this starts to break under these key moving averages, that's where we have to pay attention. That's where we try to short something. Right now, with the strength in the market that we have, we don't want to do that. But right now, you could see this happen last August. You can go back and you can analyze other periods of time where we've had short duration crises. A very good example of that was last April. That is where the money market started to have a little bit of a panic because of concerns around tax season. Well, sure enough, this broke down. The broader market broke down. We hit third Friday and the market rebounded thanks largely to Janet Yellen's quantitative support for the markets. This right here was the sell-off that transpired and correlated with the 10-year Treasury bond moving to 5%. This back here, 2023, this little panic right here, that's your Silicon Valley banking crisis. This right here, this huge move down that started in August, well, guess what? That was Jackson Hole in 2022. That is where the Federal Reserve met with other central banks from around the globe, and the market started to sell off down to here, October 2022, which was the gilt crisis. On top of that, I can do this all day. It's so fun. On top of that, this period right here in 2021, that's our Archegos crisis. And you go back to April and March of 2022. As you can see this breakdown, that's COVID. So at the end of the day, I'm just going to say, if you really want to do well when you are trying to short the market and you want to focus on those high beta stocks, this ETF is what you need to watch, and then you need to confirm it again with the FNGD. and we're going to do it all over again because I love talking about this. So once again, this type of event's going to come again. It might happen in September because that's historically when the markets are weakest. But here you go. February sell-off. This was the Nikkei crash on the FNGD. This was the tax season sell-off for April of last year. This is the bond market moving to 10% in October of 2023. This is our Silicon Valley banking crisis. This is the gilt crisis. This is the largest hedge fund sell-off in 15 years. Again, you get the point, right? I'm trying to remind you right now that sometimes the best trade in the market when it comes to shorting is no trade at all. And we are not at that moment yet. So be patient and we will take action when it is time. All right. So short sides. Don's going to sit here and tell me Don will always be first over the wall. And no doubt about it. I salute you with my morning iced tea. Again, my point is I'm going to wait. I'm going to wait. And Don, it's funny because when we were talking about Tesla a couple of weeks ago, Don said we had just met. I barely knew the guy, and he starts texting me in the middle of the night that the market's about to crash. That was March 1st. And hey, was I right? Anyway. He goes through the wall. I like that. SECform4.com is still down, unfortunately. Oh, no, it's not. It came back. Oh, yes. Let's do it. It came back from the dead. It was gone, and now it's back. Oh, my gosh. Rolling back the stone. Welcome. All right. Market. Wow. Insider buying to selling. Insiders have not been buying. This is actually mildly comical. Executives have not been stepping in and buying their stock in any particular level, particularly at all-time highs. But just to give you a little bit of a sense of what is transpiring in this market, let's do a real quick screen to start our week. Strongest CEO and CFO purchases over the last 10 days. Asana. Dustin Moskowitz keeps buying his stock in a company that I can't even tell you what they do. Elevance Health won by $2.4 million. And this is just a reminder, we are always paying attention to the amount of money paid by executives buying their stocks versus selling. As you can see, there has been ample selling in the markets because in the tech sector, most executives are paid in equity. Therefore, you see a ton of selling, 76 million in NVIDIA stocks, Robinhood stock, 40 million, BlackRock 30. Paying attention to this insider buying. It's just not there. And why do I bring this up? I bring it up because this is the single most important chart in all of finance. It is right here. It is SECform4.com. This right here, as you can see, is a spike in insider buying to selling in dollars. Well, what you're going to notice is that every time that it sees significant insider buying, that is a financial crisis that has transpired. This is 2009 with the beginning of QE. This is the ECB crisis in 2011. This is the China crisis in 2015, 2016. This was our bond markets melting down in late 2018. That's obviously COVID. Now, these spikes are all very significant, and they all came with an accommodation in policy by the Federal Reserve or by the Treasury Department or a foreign central bank. Now, what you're going to notice is we haven't had a big spike like this since 2016, 2020, 2018. Well, why does that matter? Because we keep having more crises. We keep having a Four Sigma event every single year. This is not normal. This is not a rant. The point is, we're just paying attention to the short-term pops that have transpired, and every single one of these pops on a relative basis over the last year have been buy the dip moments. You legitimately can time the market and you can buy the dip if you pay very close attention to what executives are doing with their money. The last significant insider buying to selling pop, April 9th. This is the 5-day moving average. And once again, we have not seen anything significant going back. That is why the S&P 500 and the markets are up 60 days in a row. This is the strongest momentum move that we have seen since after COVID. And I would have to go all the way back to the beginning of this century when it comes to the sheer amount of volume and strength that continues to come in to this market. So we are obviously stretched. We are paying very close attention to what comes next. But Don, I'm not going in yet. I'm waiting for it. We're going to be heavy on the SPXU when it is time. I don't know what this is, but that is a $100 million purchase. Resideo Technology, Carlsmed, Newegg, Shenandoah Communications, which is a name that I have recommended in recent weeks. SHEN, nice little purchase. Again, another $400,000 coming in for the Fiber Holdings Group. A lot of communication and a lot of ties to foreign sovereign wealth funds that are coming into the U.S. and basically just buying up all of the U.S. assets that they can. All right. One last thing. I want to point something out. So over the weekend, I wrote a piece. I was talking about a single chart. And this is, I think, the single most important chart outside of that SEC Form 4 chart that is happening right now from a macro perspective, because it tells you everything that you need to know about the current state of affairs in the broader U.S. financial system. This is the chart of the U.S. deficit and its ties to foreign capital, okay? Foreign capital traditionally would buy U.S. debt, right? We would buy long duration bonds. They would buy long duration bonds. And the reason for this is because sovereign wealth funds and pension funds need to match up their liabilities over the long term. So that's why they want 10-year bonds, they want 15-year bonds, they want 30-year bonds. Well, here's one of the problems. We have funded and focused so heavily on short duration in the last 7 years since the passage of the Tax Cuts and Jobs Act in 2017 that we have now seen an explosion in foreign investment in the U.S. equity markets. Now, why does that matter? It matters because this chart is foreign investors saying, we don't want your debt. We want your assets. So I continue to remind you, if you pay very close attention to what is happening with AI and you listen to all the terminology around bubbles and things like that, the bubble is not AI. The bubble is the United States, the U.S. equity markets. We are 66% of the global MSCI index. And this chart right here shows you that at any given moment, one big significant macroeconomic event and foreign investors can pull the rug on this market very, very quickly. But while all that is happening, there's another important element, because foreign investors, pension funds, different groups like that, are all buying the exact same stock that hedge funds are buying. Heavy exposure to the Magnificent Seven. And these are levered up, and you have a lot of rehypothecation. I don't think I'm saying that word right this morning. That said, there is so much exposure in the U.S. markets and so much foreign capital and so much leverage and so much tied to those top 7 to 8 stocks that if that unwind happens, it is extremely violent. And this is where Don gets really excited, because Don will then see that the Magnificent Seven is breaking under its 20 and its 50-day moving average. And Don is going to push all of his chips across the table and say, I'm going to have a year shorting this market in the next 5 days. That's what we're looking for. We're looking for all of the unwinding, all of the panic, all of it happening all at once, and then aiming to take advantage of things like this. Again, this is just another component of the leverage and the exposure in the global equity markets. And if you are patient and you just wait for that day. And I assure you, there's probably going to be another one this year. There's probably going to be 3 in 2026 because the liquidity cycle is expected to peak. We are probably looking in 2026 or 2027 at a market that resembles what we saw back in 2022, which is a phenomenal environment for traders who want to take advantage of volatility. So right now, watch the bubble continue to expand. Watch the market continue to run and just pay very close attention to these key moving averages because once again, the SPXL, which is another thing that I love to watch, nothing's good happens for the equity markets when we break under these moving averages. It is 9:20. I made it. Wow, look at me go. Don's coming up in 10 minutes. Guys, listen. We are in this room every single day for hours trading actively in the market. It is a phenomenal opportunity right now. We have more noise, more news, more everything going on right now. 150 companies are reporting earnings this week. We have the Federal Reserve lined up for the next 2 days. We have plenty of volatility and concerns around what's happening with U.S. Tariff policy. There's a lot going on. So get in the room with us. I hope you guys have a great day. Which is a better guide, the FNGD or the UVXY? The FNGD, because that is the leverage in the market itself. All right. I hope you guys have a great trading day. Don's going to throw in some music in a minute. I'll catch up with everybody at 1:15 today on my end. I'll talk to you soon.